Happy Groundhog Day. I mean, happy Friday from
Is it
Eagle
Groundhog Day?
Financial Management Services. Well, Wesley says that every Friday is exactly the same.
Oh,
So he feels like he's stuck in the movie Groundhog Day. That may be true, but last Friday we didn't do this. Last Friday I came in for a half day, the day after Thanksgiving, and the markets went berserk, fell the most they've fallen this year. Um, and most they've fallen in about 14 months. So we had the fall of the stock market, and then Wesley and I went to watch the fall of the House of Gucci. And oh yes, it's uh, it's an interesting movie. Um, a lot of their fashion peers don't like the way it was done, but it's pretty interesting. Got some shoot 'em up in there and some romance, and I didn't know the story, but it's got murder, all that
I
stuff.
would never have associated Gucci with a shoot 'em up movie.
Oh yes, so Patricia Gucci, yeah, look her up sometime. Google her. Well, I think the biggest fear coming into Christmas, seeing that the NASDAQ market has gotten shaken. NASDAQ market was down 2% today, and that's telling me that there's a fear that nobody's going to continue to do their Zoom meetings while they're riding their Pelotons. Okay. So, true. Um, so anyway, the
I think Wesley's still stuck in Groundhog Day.
the all-time high of the S&P 500 was just not that long ago, November the 22nd. And with today, the S&P 500 fell 0.84%. That brings us down about 4.56% in this so far. Excuse me, 1 week long correction, where what's noteworthy is the markets have S&P 500 has fluctuated at least 1% in each of these last 6 trading days. Ordinarily, high volume and high volatility like that is characteristic, Bill, as you know, of down markets. So I'm not saying that we're in some kind of bear market or down market, but there's a few things I think we're going to talk about today. Um, just have a conversation about what's really going on right now. So the markets did rally into the close; they were down significantly more. In fact, the S&P 500 actually was not down 1% today. It was only down 0.84. It was down well over 1% most of the day. But the small cap Russell 2000 was down 2.1%. The NASDAQ down, call it 2%. Bitcoin was down 5%, closing at 53,900. But yet, if I would have told you this, Bill, in January the 1st, after last year, we had a pretty nice year coming out of the pandemic, that gruesome, ugly day, down 13%. When was that? March 23rd or something like that of 2000. We rebound nicely. And if I had said to you today, back on January the 1st, that I think we're going to go up 22.67% this year, what would you say to that?
We're going to go up 22.6%.
Yeah. I wouldn't, here's my point. I wouldn't have thought we'd have a 22% up year. I mean, that's where we are right now. We have less than a month to go. We've seen a shakeup in commodities just in the last week as well, with West Texas Intermediate was approaching 80. I mean, and it's fallen 60. It's closed today at 66.41, just down a fraction. And that is, do the math, that's a decline of 17%. So that tells me there's a fear of economic growth. anyway, and then the safe havens did well today. Gold was up $22 an ounce, closing at $1,784 an ounce. That's down about 3% on the year. And the treasuries markets have been rattled as well. A little bit of a flattening going on here near term. The 2-year treasury note yield climbing noticeably up to 0.64%. The 10-year yield declining to 1.36%, and the 30 closing at about 1.7 today. So what's going on with the markets, William?
Well, you just gave us a pretty good synopsis. This has been the worst 3-day start to a December in almost 20 years. Yeah. And, you mentioned the NASDAQ. The NASDAQ has, really taken it on the chin relative to the other broad indexes. And we are seeing a surge in 52-week lows for NASDAQ components. It's just, there are a lot of things that in the market here that I don't like. And, I hate to be a Debbie Downer, but I'm going to go with this today. Tums.
Where'd you find those?
Your desk.
Yeah, Bill, the NASDAQ market, it's still, this morning it was selling at 36 times last year's earnings and is selling at 30 times current earnings. Now, that's compared to 18 times for the Dow and 22 times for the S&P. So, so there is, and we had a little bit of a shakeup there with Zoom and Peloton getting whacked.
Well, I mean, it's more than just a few individual names. I think everyone, we have instinctively, a gut feeling, when something doesn't seem right. And, we can call it a lot of different things, but I'm just saying my gut feeling is not too keen on the markets right now. Call me Debbie Downer. But I don't think anyone heard that. We'll do it again. So I'll be the Debbie Downer of the program today. There are a lot of things that make me a little nervous right now. And, you made the comparison to a year ago, and would we have thought that the markets would have done as well as they've done this year at this point from this point last year? Well, things are very different at this point than they were a year ago. A year ago, we were coming off of pandemic lows. The economy had been effectively shut down because of COVID. And we had a very, very accommodative Fed along with an accommodative Congress through fiscal stimulus. What that has done has invited a lot of speculative market behavior. Irrational exuberance is amongst us, and certainly in pockets where we can see it manifesting in big ways, like in meme stocks, cryptos, stocks like Tesla, and we're seeing the same kind of behavior that we've seen in the past when there have been market excesses. And you see, people trying to rationalize it. Investor behavior is always the same when markets are getting toppy. And you'll see all kinds of justifications and rationalizations for why market prices are what they are. This time is different. Well, sadly, it rarely is. And people have a short memory, when it comes to market exuberation. But yeah, things are different right now, and now we are facing a Fed that is looking to taper. They've announced their intentions to taper, meaning they're not going to be as accommodative going forward. We're not going to have the fiscal stimulus that we've had in the past. Go ahead,
what does
Jack.
that mean? Not all of our viewers would know what the term tapering means.
Yeah.
So it began really with the subprime crisis in coming out of 2008 that Ben Bernanke was actually the Fed
Mhm.
chairman then. Remember the helicopter money and
Oh
all
yeah.
that. So the Federal Reserve started expanding their balance sheet. When central banks aren't normally supposed to have a balance sheet, they began buying electronic purchases of mortgage-backed securities and U.S. Treasuries from the bondholders, and so they continued to do that. Many people find them at fault for still having done that. So they're going to continue. They're purchasing right now. I think it's $120 billion a month divided between mortgages and treasuries. And so those purchases are going to be scaled back to the tune
Mhm.
of 10 or $20 billion a month until they get to zero. Then you could say they're not accommodative, certainly not accommodative as much in what Janet Yellen began after Bernanke by declining the balance sheet and selling those bonds back to people like me and you and insurance companies and corporations. So that is, just to reiterate, they are uh, soon going to be
Mhm.
tapering bond purchases.
Well, and they're not going to stop or taper anytime. I mean, it's not going to happen today or tomorrow. Um, but we know that markets move on what the Fed says, not necessarily what the Fed does. And markets are anticipating this. The Fed has said as much. They've also, thrown out there the possibility of raising short-term interest rates, because many people feel that the Fed is behind the curve in terms of raising short-term interest rates to keep inflation in check.
And Bill, just like you mentioned, the market's already moved on that.
Yeah.
So, and we had the 2-year Treasury note yield down to 0.2%, and it's already climbed to 0.64. So that's forecasting future rate hikes.
And we know historically when the Fed tapers, markets sell off. That's the pattern. Markets have gotten addicted to Fed stimulus, and at some point it has to end. We can't continue doing this ad infinitum. So yes, I fully expect market volatility to spike. We've had market volatility spikes. The VIX, which is commonly referred to as the fear index, it jumped up 24% today. So we're seeing the VIX move up. Markets are coming down a little bit. I think this is more about the Fed than it is about the Omicron variant.
Yeah, that's good that you mentioned that, because I think that essentially, if we just wanted to dumb it down
I'll
for
let you
us,
dumb it down.
there's two things that have really rattled the markets in the last week, which has made us fall almost 5%. And that is Omicron. I noticed that last Friday they were calling it Nu, the Greek letter N, and somehow that got changed to Omicron. But everything that I'm reading about that, and I know you would have. I guess it was 2 days ago that the first case was found in San Francisco or in the United States. It's crazy that everybody knew that it was coming here, but yet when someone announces that somebody's got this thing in San Francisco, the market immediately
Mhm.
fell 1%. So now I think we're in what, 6 states or something like that. So that's something that we could discuss more. So that's number one. Number two is a meeting where Jerome Powell came out and pretty much confessed that they're behind the curve with
Mhm.
inflation, and they're going to have to start doing something about this. And really, the naysayers have been telling them this for quite some time. So for him to come out and just say this is really a huge loss of credibility on the part of the newly appointed Jerome Powell.
Yeah, I mean, I have a little different take, and when it comes to the inflation and this whole idea of is it transitory, and that's Powell's word. Powell was the one who introduced that into the vernacular, and he's the one who walked it back this week. Some things are transitory for sure because of the supply chain disruptions, but we're seeing things in the data that are indicative of disinflation, even deflation. And I think the markets are starting to react to that. And we're seeing the yield curve flattening, the dollar rising. We're starting to see some commodities like copper rolling over. Why hasn't gold done better than it has? That to me is a little disconcerting.
Well, here's the other side to that. Here's an article that Saxo Bank just put out, and they're predicting inflation hits 15% by October of next year.
Yeah, I mean it could happen. That is an outlier prediction. It's entitled outrageous prediction.
Yeah, they have a number of them, but I mean they give a pretty good justification for this, and I'm actually in that camp. It seems obvious from my vantage point. US CPI, we've got higher inflation right now than we've had in 31 years. And I think that the big story here is 2/3 of all inflation comes from unit labor cost increases. And the most alarming thing in determining what inflation is doing is you have to look at what's happening with the labor force. Incidentally, we got the jobs numbers this morning and
not good.
They were not good. But 4.4 million in August, 4 million people left the workforce. In September, another record, 4.4 million people left the workforce. So they say, quote, by the fourth quarter of 2022, US CPI inflation reaches an annualized 15% as companies bid up wages in an effort to find willing, that's a big thing, and qualified workers. That's a big thing with so many people. Mm-hmm. I think because of COVID having decided that they're just done going out of the house, triggering a wage price spiral unlike anything seen since the 1980s. And I think that given the actions of our Federal Reserve, you could liken the same thing to when the Fed chair, McChesley Martin, misjudged that they were behind inflation. And then we had, Paul Volcker come in and have to, tighten tremendously. So I'm not in the, I think Omicron is transitory. And I think this virus is ultimately going to be transitory, but I think we're likely in a commodity price super cycle, and we've already got the highest inflation we've seen in 31 years. And we've got the fundamentals that are occurring in the labor market are powerfully inflationary.
The thing about labor inflation, and yes, I mean, labor inflation is sticky, and we could both be right in that we can have economic decline and inflation at the same time, and that's called stagflation. And the Fed did indicate as much recently that we could have a stagflationary environment. It was the New York Fed President Williams who was saying that basically. But one thing about
we have that right now.
One thing about
with the commodity prices.
Well, yeah. Commodity prices are starting to taper off, and especially leading ones like copper. The Baltic Dry Index. We're seeing some rolling over in commodity prices. But when it comes to labor, here's the thing: the labor force participation rate has been very, very low, And yes, there are people who have just pulled out because they've been disincentivized from working, because they've been receiving stimulus from the federal government. That's going to come to an end. People will have to go back to work. They have to eat. They have to work. And so people will come back. And we're going to have structural unemployment from things like automation. You know, like this is an anecdote, but I heard recently about a McDonald's franchise owner, and he was asked about not being able to hire people and the effect on his business. And he was actually happy about it. He says, in a few years, I'm going to be so automated, I'll only need a couple of employees. So the fact that people are pulling themselves from the workplace over the long run just invites in automation, which keeps prices down.
But in my view, the bigger picture is what's happening demographically. You know, there's a demographer named Harvard grad named Harry Dent, who's made some wonderful predictions, watching the spending patterns and so forth of 25-year-olds or 50-year-olds and 65-year-olds. And if you, the biggest single factor that I think is contributing to inflation right now is the worst it's been in 31 years, and I think worsening. And I think the you know, the little wave that we've seen of commodity prices in some areas declining a little bit, it's definitely not happening in across the whole commodity spectrum. But if you look at the number of workers in like Asia, for example, Japan, China, the United States, the baby boomers coming of age and leaving the workforce. If you look at, we have a very old population, and people, that's what's happening, is people are leaving the workforce because they're old. We haven't had the birth rates, you know, that we've needed demographically to sustain the employment needs. So that's what happens at the margin, is that you have a business, and I'm seeing this in the services industry right now. I've eaten at 3 times in the last 2 weeks where the restaurant only had one server. And I don't think that gets fixed anytime soon. And it could even worsen.
Yeah, the restaurants shut down.
Yeah.
That's the problem.
So, yeah, I think, and
Which
I think
only
it's
adds
cool.
to unemployment.
There's definitely, William, a tug of war between some of these different forces.
I think on the inflation front, I think we're going to see data that can support inflation, data that can support disinflation, deflation, and it's going to be confounding. But regardless, right now, I'm of the view that everyone needs to be paying attention, not being complacent, and like I said at the beginning, we're seeing toppy market behavior. We're starting to see some things that you know make me a little uncomfortable, and I would not want to be speculating. I would not want to be paying for overly priced securities. This is the time when you really need to be paying attention.
No, that's
and right as I said, I will gladly be the Debbie Downer today.
It's interesting, you know, to note this is a time of year as we come into January. And it's going to be interesting because we mentioned on a prior episode, Bill, you did the legwork on this of things to do at year end. And I think we're going to see higher taxes next year as well. So
what would that do to the markets?
That's definitely not good for the markets. But there's going to be there's every year there's a rotation, is where I was going with this. There's going to be a rotation, institutional rotation, out of those things that no longer appear to be attractive. And some of that's what this selling pressure is right now, like Zoom and Peloton, you know, or PayPal. And PayPal's down from 310 to 182. I looked at that today. So, things like that, names that are selling, PayPal selling at 35 times uh, current earnings and 45 times last year's
Mhm.
earnings. Now, they've had earnings growth the whole way through there, but
Well, but also these are lockdown stocks. So, I mean, these are names that did very well during the pandemic lockdown, as people were stuck at home. And so those are, speaking of rotation, those are names that benefited during lockdown and they were rotated out of.
yeah. So then we're going to have fiscal stimulus too, which I think is again going to be very inflationary. And I think it's difficult to trust. This is not a political statement, to trust what we're hearing from Washington. I think that's true no matter who's in office. So that we've heard this notion even from Janet Yellen that stimulus is good and won't be inflationary. So yeah, there's. But what do you think about the virus end of it, William?
I mean, the Omicron.
Yeah.
I don't think that the markets are nervous because of that, and I think people are starting to come to understand that with these variants, the severity, the lethality is declining, and that's kind of what you expect with the virus. And I'm no doctor, but with viruses, they do evolve that way because they want to survive, and if you kill the host, then you can't survive. So from everything I've read, this newest variant is much less lethal than previous variants, and people are starting to understand that.
Yeah, and I agree. So that creates opportunity. If some of this sell off, which I think it has been linked to fears of what this virus is going to do, and I've read recent comments that Bill Gates thinks that this thing could just about be over with, next summer, or it could be viral yet not lethal enough, like very much like the flu by next summer. So so anyway, those are the two things. We're going to have to watch this inflation thing as well. What else did you have for us, William?
Watch the bond market, watch the yield curve.
Yeah, I think where are the opportunities with that? So I think we haven't owned conventional bonds all year long, but with the 30-year Treasury bond yield trading to yield 1.7%, under normal circumstances, bond yields have traded 2 percentage points over CPI inflation. So that you're not, if you've had someone this past year that's had 100% of their bond portfolio in something like U.S. Treasury securities, well, first off, they've lost money. You look at the very popular Dodge and Cox Income Fund; it's lost 1%. We think our largest bond holding fund has made 7.2% this year. So we've done things very, very differently. But conventional bonds, you know, the way to make the most amount of money is to be a contrarian, but it also requires that you're right. And if you follow the flow, the near-term flow in long-dated U.S. Treasury securities, there is a tremendous amount of risk in that.
Yeah.
So if you buy a 30-year Treasury bond today that pays 1.7 and yields go to 2.7, you'll have a 20% decline in the principal.
Well, when I say watch the bond market, watch the yield curve, what I'm saying is watch it for the message that it conveys. I read this today on Twitter. I thought it was hilarious. Interest rates continue to fall on fears of rising interest rates.
Here's
So
one.
the CPI is a backward-looking number. The bond market is pricing in future. So the bond market is sending a powerful message, and that's why I say keep an eye on the bond market.
But the the other side of that is the bond market has been a manipulated market that you can't trust. You can't even derive inflation by comparing the nominal treasuries to inflation protection securities, because these are the most manipulated markets in the world, and that would project 2.7% inflation, but I'm kind of in the camp with Saxo, and as Bill is talking about exercising caution. It seems this month we've got people right now looking for reasons to lock in profits, for this year. So
I think that's wise.
I think that's wise. Yeah. Now's a great time. If you started the year 50-50 in stocks and bonds, and you look at your account and it's 60% in stocks and 40% in bonds, it would be a great time to rebalance that. We wouldn't be buying conventional bonds in the bond market with that rebalancing. But
All right. Well, I know Wesley is giving us a signal. Is it time?
okay, sports.
That was not the same.
Saints last night.
Oh, that's a definite
was-
womp womp.
Taysom time. Looked like he broke his middle finger on his passing hand, hitting a defender, and he threw 4 interceptions after that. So it's going to be, but I actually saw potential. He rushed for over 100 yards. Huge rivalry here between Cowboy fans and the Saints. This weekend, the big game is, and the big sporting news is Coach Kelly leaving Notre Dame to accept Ed Ogeron's position.
And overnight acquiring a Southern accent.
He's going to need to do that if he wants to recruit. He needs to know how to say "Go Tigers."
I didn't know a man from Massachusetts could talk like a Southerner, but he tried.
And only 2 weeks ago, he said, "You can't give me $250 million to leave Notre Dame." Well, they're giving him $100 million.
Well, he was right.
Huh?
He was right.
The big game of the weekend, though, tomorrow, I'm waiting with bated breath. Alabama is a 4.5-point underdog against Georgia. And if Alabama loses, I think they're out of the college playoff. If they win, I think both Georgia and Alabama are in. But I would never count out Nick Saban.
I'm counting out Nick Saban.
Okay, I'll take the 4.5.
Georgia wins by 10.
Okay, good. I think that's about it for this afternoon. It's going to be interesting to see what happens when we come in here Monday morning. And we're students of the market every day. We're always looking how to better position our client portfolios. Where are the values? There are values that emerge when things get shaken about. So this is what we do and what we love to do. If you have any questions or comments, please give either of us a ring.
Pay attention, folks. Pay attention.